last 1 hour of the trading week, and it has been a decent one because we have been making fresh record highs pretty much every day. Today we scaled past the level of 25,800. From there we did cool off a bit, so we're almost 100 points off from the day's highest point, but can't complain much with the kind of rally that we have seen underway in the markets. Today, at least, the broader markets are participating in the party, so that's the positive news. Both the mid-cap and the small-cap indices are trading in the green, and the Bank Nifty continues to be toe-to-toe with what the frontline index is doing, so there is decent amount of participation coming in from Bank Nifty. But it's fairly broad-based today. All the sectors are in the green right now. Metals has been one space which has been powering ahead this rally, so that index is up 2%. Macquarie had upgraded the entire space. JSW Steel, JSL, Adani Enterprises, which also got a bit of a bump up, is also in the trading session, up with a gain of around 2 to 2.5%. Autos, take a look at M&M, that almost a 5% rally coming in on M&M alone. Eicher Motors is doing quite well. Bosch, Maruti, Escorts, these are some of the other names which are holding up. In terms of the individual movers, ICICI Bank has come off materially from the highs of the day, but still holding on to a gain of 1%. HDFC Bank is doing quite well. Now it's up almost 2% in the trading session. L&T, Reliance, M&M, these are, of course, your top movers. But from the broader markets, it's a PSU basket that is really bouncing back today. Take a look at Cochin Shipyard, Garden Reach, Mazgaon Dock. All of these three stocks are in focus. Of course, there's the news flow of the FTSE and Sensex flows coming into a couple of these counters, and they're buzzing on that. But overall, I think, Aisha, after the kind of drubbing that the PSU stocks had seen for the last couple of weeks, maybe a bit of a recovery.
Yes, a recovery, definitely. If you look at Cochin Shipyard, for instance, from its 52-week highs, it's still way off the mark. But from yesterday's carnage, it's it's definitely seen a mild bit of recovery. Not the 52-week move, but the fact that it's 38% off the recent highs, that I think is the critical point. Today, of course, making up with that 10% jump. Similar is the case with the rest of the list as well. Look at Hoodco, for instance. While its 52-week high was that of 354 odd levels in trade, it's 249, but 8% of a jump coming in today. Similar is the price action on an IRCON, MRPL, Engineers India, UCO Bank. You can go on with the list. Quite off the mark from their 52-week highs, but today most of them are making a solid comeback, and this is especially in the light of the kind of weakness that most of these names saw yesterday. But let's welcome on board our chartists and our fundamental experts and figure out what is it that lies ahead, what is it that next week is going to look like. We've got Naresh Mirani, we've got Andrew Holland as well, and Kunal Bothra will be joining in just shortly. Naresh, firstly, just a chart check, because today, as I see it, the European stocks are all down. Seems like we are playing catch up to yesterday's price action.
Yesterday was a strong tick across the world. We did not see a similar tick. We are seeing a tick today, but overall there is volatility in the day, given that there is some recheck also at 330. So there would be some more volatility around that price, around that time. But the bias is positive. The breadth is positive. The good part is we've seen finally the Bank Nifty take some leadership, hit a new all-time high. And that was one of the missing parts of the rally till now. So if that comes off, private banking as a sector seems to be the new rotation to play for, whether it is large or the small names in that. So that would be a play to watch out for going forward. And in terms of the broader markets, we're yet to see a new all-time high today on the broader markets, but the breadth is much better than what it was yesterday after it took a knock.
Point taken. Just taking stock of some of the stocks and news, then you have IIFL Finance, which is doing quite well after dropping it saw yesterday, because RBI has finally lifted the restriction imposed on the gold loan business of the company. The management did speak with us earlier in the day, and those graphics and details will come up for you on the screen for the stocks and news, because it did talk about the fact that there is going to be, of course, the business which will resume. The market share gains will happen, but of course it will happen on a calibrated basis. ITT Cementation is the other one on our radar, up 19% after reports suggest that Adani Group has emerged as a front-runner to pick up almost 46% stake in the company, so 20% higher on that one. Tata Steel up 2.5%, JSW Steel up almost 4%. Macquarie has raised the targets for most of the steel companies. JSW Steel is what they have upgraded to outperform, and for Tata Steel the target price is 171 rupees. So some of these stocks in focus. In fact, Kunal, metals as a basket is something that you have been pointing out as to how it's poised for a recovery. But do you think the first leg of the rally is done and one should start booking profits also? Do you think there's a far way to go for this one?
And there should be a substantial upside for the metal counters. What we are seeing today is after last, I think 3 or 4 days of appreciation price rally and then the correction, the indices are managing to, the Nifty metal index specifically is managing to hold on to its 50-day moving average. So there's a decisive bounce which has happened into the index. What we are seeing is also a breakout for many large cap names or many individual stocks, the likes of JSPL, JSW Steel. These stocks have confirmed very strong breakout potential for themselves, and that too on the back of some encouraging volume patterns. So I would believe that this could be a substantial up move for the metal pack. Now the question is that when would be the large cap names or the underperforming stocks like Tata Steel, SAIL, etc. When these stocks could make a comeback. I think when that happens, that's where the pace of rally and the momentum could get much more on the higher side. Right now, what we are, I think what one should be looking out for is just about trade these individual stocks as of now, JSW Steel and Jindal Steel on the upside. And once you see the momentum catching up from the other beleaguered names, that's where I think one could probably start to look a lot more broad-based in the metal counters.
Right. Okay, let's welcome on board Andrew Holland as well and figure out what he's making of the market. Andrew, quite a surprising reaction. Even though it was that outsized cut by the Fed, while the global markets did what they did yesterday, we seem to be moving today, while yesterday we were somber. What is it that you're making of the India market construct in particular? Because, I mean, theoretically, a rate cut in the US would mean more money flowing to emerging markets.
No, it's exactly right. And I think that's what the market's now, our market's now kind of realizing that there's two points to this in terms of emerging markets. One is that, we still expect more, another 75 basis points of cuts in the US, with most likely at 50 basis points again in November, then 25 in December. That will probably weaken the dollar in the short term. And that's always great for emerging markets and commodities. So that's your first kind of line of move in terms of the emerging markets and commodities. The second point is that given that outsized move by the Federal Reserve, I think the market's going to wonder whether the Reserve Bank of India will actually pivot in October with a small kind of reduction because the economy is slowing. But for sure, they're going to do something in December. So, a little bit like what we saw in the US, you're going to start seeing the markets, moving towards the interest rate sensitives because it's going to happen this year. Therefore, the banking and NBFC stocks will be the ones which will power the market ahead, which we're seeing today. But I expect that to continue in the run up to the RBI meeting as well in October.
So that's the latest coming in as far as what the impact of Fed rate decision is usually on the emerging market economies and what we should expect from the flows. But what's the take, Andrew, when it comes to the PSU basket? Should one look at buying afresh or just stay away? What's the view on PSUs as a whole?
So I think, I can look at PSUs, but I think that the play at the moment is large cap private banks, NBFCs, and commodity stocks. And I think, once you get those moving, then you'll get the PSU stocks within those sectors also doing well. But I think that the first call would be the kind of non-PSU stocks, the large cap stocks, which I think will power this market.
Large private banks definitely, and they are powering ahead quite a bit, and given the fact that the underperformance has been stark, there is that room of upside as well. What about autos? Because there were reports coming that perhaps the registrations have been on the weaker side, there are heavier discounts, a lot of inventory in the system, but today they are perking up again. What's the view on auto then?
No, I think we've had a positive view on auto, but I think that this last kind of extra move up is more to do with the festive season coming up, and also the likelihood that interest rates will fall, so that will help demand into the back end of the year. I think it's going to be a bit more of a struggle for the auto stocks now. So if anything, I'd be moving some of that shorter term gains into the sectors I just mentioned, which is banking, NBFCs, and commodities.
Kunal, tell me, what about some of the defense PSUs in particular? I mean, and I would add railways as well in there. I mean, the likes of a Cochin shipyard, what we're seeing in terms of a price action pretty much across the board with a BEL, etc., Hoodco, etc. as well. Of course, this is outside the defense and railways pack. Do you sense that this decline that we saw yesterday, even though there is a meaningful rebound today, can it sustain? And if they were to decline further, would you recommend increasing exposure to this space, or would you say there's lots more moving in the market, focus on that?
No, I think we are into a classic sector rotation play. So that's one point, because over the last 3 months, so there was a phase, for example, in the month of March, April, where private sector banking stocks, the IT, pharma, FMCG, they were underperforming. And then subsequently, after 3 months of underperformance, there came a phase where for the next subsequent 3-4 months, these stocks, these sectors, they start to outperform. Now, on the defense pack, on the railways, the PSU basket overall, the last 2-3 months, I think from the June highs or July highs, these stocks have been underperforming. Defense stocks particularly, they've corrected by, I think as an average 30% to 40%. Some of them have corrected much more than 40% from the defense pack. So I think what we are going through right now is a phase where the selling is getting exaggerated into the high beta or within the defense pack high beta stocks, and it's a bit more above the average for many of these other larger cap names. Now, I would probably believe that today's data or the price move which we are seeing for the defense stocks is the first sign that volumes are coming back into the stock on the positive side. So over the last 2-3 months of this selling, there was always high volume candle for the stocks individually, but that happened when the stocks were actually going through a sharp selling pressure. So for the first time, we are seeing a reverse of this patterns. This means that a bottom could be very close for many of these defense names. So by a margin of say another 5% or 7% broadly from current levels, I would probably believe that this is a very good time to average out many of the defense stocks and look out for say another 5% to 7% dip in case if it happens over the next subsequent 1 or 2 weeks as a good averaging opportunity further.
Okay, but since we are talking about the entire shipping space, I think we can also go to Prakash, because there is this announcement coming in that there's a new policy for the shipping sector that might come soon, and that could provide this added fillip, and perhaps the reason why some of the stocks are buzzing in the trading session, because financing, ownership, insurance, leasing and shipbuilding, these are the various reforms that they have been talking about. Prakash, tell us what exactly are the details, because we're trying to understand whether that could be one of the reasons why some of these stocks are up 10%.
Yes, sir. We are learning from our sources that the government is likely to announce a new policy for the shipping sector very soon. We are given to understand that the shipping ministry has just started the process. In fact, inter-ministerial consultation has been initiated where the ministry has sought inputs from the other related ministries. A very significant development coming in. The new policy will cover entire value chain in the shipping sector, and the shipping ministry is planning to get cabinet approval within 2 months. Along with that, in fact, the government intends to undertake various reforms across areas like financing, ownership, insurance, leasing and shipbuilding. In addition to that, the new policy will address ship manufacturing and recycling measures as well. Sources are informing that the policy is being developed on PPP mode, where private sector will get funding support from the government. Along with that, some legislative amendments are expected to provide flexibility in financing model. That's a very significant development coming in, and the shipping ministry has initiated the inter-ministerial consultation, which is likely to be completed in next 2 months, and that will help government to achieve goals outlined under Maritime India Vision 2047.
Okay, Prakash, thanks so much for that. So yes, a lot of these stocks buzzing in the trading session, and that could be part of the reason. A quick break, but when we come back, we'll put the spotlight on the housing sector. We'll also have Ghulam Zia joining us to talk to us about that, because we understand that perhaps there could be some sort of discounts and rate cuts coming in as far as Maharashtra region is concerned. All of that on the other side.
Still in conversation with Andrew Holland, our chartist. We have Ghulam Zia as well joining in, and here's the reason why. Another ET Now news break confirmed, and it seems that the Maharashtra Housing Minister, he's in fact told ET Now in an exclusive chat that the government is planning to slash stamp duty in real estate before the festive season itself. Let's listen in.
Our government earlier, like in COVID period, had given concession to the stamp duty, and because of that we got more revenue and lot of registration. The housing department, there was a good response from all the stakeholders, all the builders, and that's why we had given that time in COVID. Same thing, we are planning to give some discount so that we get more revenue from this registration.
You're planning to give, because the festive season is coming and after few days, a model code of conduct would be applicable. So can we infer that before that you're planning to give some sort of discount?
We are discussing with the revenue department. Definitely once the revenue department and housing department come together and decide it, we'll be able to do it. But already as we have given 1% discount to the women's for ladies, because so that if there's some house has been taken in the name of the wife or sister or mother, they get a 1% discount in that.
So you're giving 1% discount to women and they may get more before in this upcoming festive season.
Yeah.
You are working on that proposal, sir.
Yes.
So one more thing, I just want to understand that in Mumbai, the real estate is the most costly real estate of the country. And one of the reason is the premium charges. So is there any plan to reduce the premium charges?
As we said, we are coming up with a new housing policy, and definitely we will be trying to reduce, because that is everywhere whenever we go for any conclaves, there all the stakeholders always say that there should be reduction in premium. So definitely we'll bring in our new housing policy, we'll try to reduce the premium.
And sir, what is the latest update on your new housing policy? By when we can see, and how much work has been done on the new housing policy?
Housing policy is already been completed. Only all the departments together, because it has to be decided by all UD, housing and all put together. So I think we will be able to finalize in next 15 days that.
Okay, so the housing policy coming in 15 days, and there could be some discounts coming in as far as the Maharashtra region is concerned. Before I come to Gulam, a quick word, Andrew, as far as your take on the real estate sector is concerned. Okay, actually, Gulam is with us, so let me ask him that. Gulam, do you think this kind of push is really needed in the MMR region? Because on one hand, you had the builders talking about how the sales have been good, that entire flip-flop of the tax that happened in terms of LTCG was rolled back as well. Is this something that is really a need of the industry right now?
Well, you have a very valid concern. I don't fully agree that this is needed right now, for a simple reason. As you rightly said, the transactions month on month have been breaking records. In fact, for last 6-7 months, every month has been better than the last year same month. And even stamp duty revenue collection wise, if I'm focusing only on the registration of apartments, that is sales of apartments or homes, we have been collecting more than 1,000 crore for 7 consecutive months, which is a record in itself. So prima facie, you don't need much of a discount over there. However, one thing which is a cause of concern is that the prices of the houses have been shooting up. And that is a concern. At some point of time, the market will have to take cognizance of the high prices and inflation in real estate. And then, if they're talking about a percentage of a reduction in stamp duty, it will be a breather. It will be a good step. But more than that, what the minister, I heard him talking, is about the premium cuts, which is a very good step. And then it will be for the developer to decide whether they pass it on to the buyer or not. But at least on the government side, there is an initiative, there is an inclination, which is a very welcome step.
That's exactly the point. I mean, stamp duty and the premium etc. form part of the cost. What if the builders don't pass it on? And right now as well, it is up to the builders to at least try and cut the prices a bit, because as you talked about, it's escalated quite a bit. Why is that not happening then?
Well, you know, one of it, the stamp duty is not in the developer's hand, but passing on the premium discounts is definitely in their hand. So that is where my about the premium alone. But your point is valid. You know, if the transactions are going on, if there is enough of a demand, it's a simple economics. There is no compelling reason for developers to cut the prices if the economy is saying that whatever they are constructing, whatever they are seeking, they are getting the prices. So that is a concern, that unless some change of trend is observed, the developers would not take that as a signal and look at cutting the prices. Till such times, the prices shall continue to rise unabashed.
Andrew, just want to get you in as well over here because, while this really worked from those COVID lows when everyone did aim to to buy a higher or rather bigger home. But do you think that a move like this, if there is any sort of discount, a stamp duty reduction, is it going to act as the big kicker once again for realty because the sector is already in a boom?
I think it helps continue that boom because with those kind of incentives plus as we spoke before, interest rates coming down and likely to go down, at least 50 to 70 basis points in India alone. So that's the extra fillip you need for the housing market. So I would have thought most of the housing stocks will rise on the back of this on the combination of those factors. Because it's all very positive, right? It's going to keep the momentum going for house sales. So it's good news.
But Ghulam, just wanted to get a better sense. Do you think, which segment do you think will benefit the most out of this discounting if it does happen? If there is a bit of a breather, which segment do you expect will see the takeoff first?
As we've seen earlier, the earlier time that even Minister was referring to, during the COVID period when they brought in the stamp duty cuts, the first segment which got, a sudden change was the premium and super premium segment. Because if you also look at the quantum, that 1% makes much of a difference when you're buying an apartment for 50 crore vis-a-vis when you're buying something for 50 lakh. So that segment, the uppermost segment, will get the very positive sentiments changing with that. However, for the lower end, it may still not be as much of a breather as you would anticipate it to be.
Really a breather be coming in for the upper strata, and Ghulam making it clear that there's not a big need per se of the industry right now because the demand is very strong, and clearly if they had to cut prices, the developers could have bitten the bullet and kind of taken that, but they're not doing it because the economy is telling them that there's a good amount of traction in the sales. Thanks Ghulam for waiting by patiently and speaking to us about the subject. Let's see what those discounts actually take shape into as we head into the festive season. But continuing our discussion with our other experts, and Andrew wanted your take regarding a couple of other spaces as well, especially the entire exchanges and financial ancillaries. There's a lot of talk around IPO coming in of NSE, the kind of valuations it's been getting in the unlisted and private markets. BSE has seen a massive run up this week itself. Would you be betting on a theme like this?
The exchanges is something that we like, and there's quite a number of them listed. So they would all benefit, obviously, from an IPO listing of the NSE, or put some extra value, to be garnered in the very short term. So, and again, we go back to the kind of volumes that you're seeing, across the board. So, along with asset management companies, again, this is a trend. We're going to continue to see over the kind of next 3 to 5 years. So I would say that we'll probably see valuations get a bit racy ahead of whenever the NSE lists. But until then, you can enjoy a strong up move even from these levels.
The big talking point, Andrew, also come Monday or over the weekend is going to be the Swiggy IPO. There are all reports doing the rounds that maybe the IPO is going to be filed this weekend itself. It was supposed to be done this week, so now conjecture is just 2 days left for the weekend, so maybe it's going to be then. But looking at how Zomato has been absorbed by the street, how they've been running their business now, what's the anticipation from Swiggy, and is it going to be one of those IPOs that you can't miss?
Yeah, I can't really comment on that, but I think I think Zomato in terms of if you go back a year and a half ago, I think the price was under 100, right? And it's really kind of moved into strong kind of profitability and cash flows, and I think that's what the market's liked, and it's liked it across all these kind of enterprises. So I think that's that's the kind of outlook for these kind of companies now. It's completely changed from it was a year and a half ago, and I think we'll see more and more listings like this. So, and I think the market's liking this overall kind of total market kind of capacity that some of these companies can capture over the, not just in the very short term, but over the long term as well. So I think that's captured the imagination and the valuations of some of these companies as well.
We let you go. Thanks so much for making time and speaking with us. Quick take at the markets and some of the big movers. On the gaining side continues to be Hudco, GRSC, Max Healthcare, BSC, big buzzers. But Naresh, what's the closing trade idea?
So that would be a buy on Havells. The stock has clearly shown good momentum and hitting new all-time highs here, a flag breakout as well. So expecting this to continue the momentum towards 2100, 2200 levels.
Haven't talked about that one very often of late, but clearly expecting a breakout there. Kunal, what about you?
So I'll go with the Scots as a closing trade after this kind of a strong up move where the stock is up 5-6%. It's confirming a double bottom breakout, and this could almost be like a 200-pointer up move. It's already moved up some 60 to 70 points, but there could be an upside potential of another 130, 140 points for the stock of the very near term.
Right, okay, let's take a very quick break, and as we do that, let's hear out from none other than Chris Wood from Jefferies as to where is it that he's finding value in the markets right now.
To me, the private banks, or indeed the IT services companies, are kind of the low beta areas of the portfolio. So in a world where we get a correction, these sectors will be, in my view, outperform. But I think the drivers of this current bull market we've been in have been more in the energy, infrastructure, real estate area, and my guess is that these remain the key drivers of the story. But clearly the banks are overdue some outperformance. The banks have also had a bit of a regulatory headwind because the RBI has been quite preemptive in terms of regulatory initiatives in recent months, which in the short term is negative for the banks, but in the long run it should hopefully be positive because it means that the credit cycle should be maintained for longer without disruption. So I'm maintaining banks in my greed and fair India long only portfolio, but I've also maintaining the more high beta areas like capex, real estate, energy.
Welcome back. Well, come Monday morning, perhaps we'll be talking about a new entrant which is looking at getting itself enlisted into the bourses, and that could be Swiggy itself. We understand that perhaps the IPO filing could happen as soon as this weekend itself. Let me take it across to Sharat to get the latest on this one. Sharat?
Well, as the reports suggest that Swiggy might be filing its IPO this weekend, and they aim to raise roughly $1 billion, almost 8,400 crore rupees. Interestingly, SEBI approval is still waited, and the exact details of the offering of the size as well as the timing is still not stated. Now, the company is aiming for almost a $15 billion valuation. Also, the key shareholders involved in the company includes Prosus, SoftBank, Elevation Capital, and even Tencent Qatar Authority, as well as GIC. Now let's compare Swiggy and Zomato overall. We get to know that the revenue numbers are actually even Stevens, but the Swiggy has actually not been profitable, and over here they are having a loss of 2,350 crores in FY24, while on the other hand Zomato has been profitable. The average order value, that is roughly at the same at 428 rupees. And if you look at the operational numbers itself, be it the monthly transacting users, restaurant partners, cities they are present in, all of them are in the favor of Zomato. Also, the market share, Zomato is having a higher pie of almost 54% in the food delivery segment, while the remaining 46% is for Swiggy. Also, let's look at the valuation, how it has actually panned out. Swiggy expected $15 to $18 billion of valuation, while currently Zomato is sitting at $30 billion. Also, the quick commerce space, that's where the competition has heated up. It's almost even Stevens when it comes to the number of dark stores as well as cities which they are present in between Blinkit and Instamart. Also, some big names have entered in the IPO segment. Listed company Hindustan Composite bought almost 1.5 lakh shares, valuing the company at roughly 57,750 crore rupees. And also reports suggest that Madhuri Dixit has acquired 1.5 crore shares at roughly 345 rupees per share. That's expected to be the CCPS, as the equity shares are trading higher on the unlisted market as per channel checks. Also, the revenue growth 36% for Swiggy for FY24, while Zomato it's 71%. The per share value in the equity in the unlisted space, as per our channel checks, for Swiggy is ranging between 360 to 380, and the current market price is near the 300 mark for Zomato, coming in at almost 288 to 290. Also, the gross order value as per FY24 numbers, that stands at 24,700 crores when it comes to Swiggy, but on the higher side for Zomato, coming in at more than 32,000 crore rupees.
Okay, right, Sharad, we leave it at that. All excitement around Swiggy and whether or not it's going to match up to its only peer, that's Zomato, in the market from within, of course, the listed universe. But Arnab Das as well joins in on the show to talk about what he's making of the global markets. Arnab, hi, afternoon. Good to have you in ET Now as always. Thanks for taking the time out. An outsized cut, Arnab, by the Fed. What is it going to spell for emerging markets? And is India still the preferred of the lot from EMs?
Well, thanks for having me. Always good to be here. Yeah, look, I think the Fed, sort of began teeing up this bumper first rate cut in Jackson Hole back in August, and gradually moved the market in that direction, but not fully. So I think this 50 basis points cut, it's quite unusual for a variety of reasons. Usually you don't lead with a 50 unless there's something seriously wrong. But I think in a way, perhaps it's a dovish 50, and to some extent it's a hawkish 50, right? Because they were sort of signaling maybe not that many more 50s to come, right? Perhaps none. And the market is still pricing a bit more of a front-loaded rate cutting cycle than the FOMC dot plot. But I think, on net, the balance of the effect is somewhat dovish, as we see in the in the reaction in the stock market and the steepening of the U.S. yield curve into positive territory for the first time in quite a while. So I think, what the market is telling us is that the Fed is going to probably be quite successful in engineering a softish landing. And I think ultimately that has to be good for the world economy, because the US is still the main source of demand, right? China is growing more slowly than before. Its trade surplus is increasing. There are concerns about overcapacity and some issues on that front in Europe as well as the US and even in some emerging market countries, including India, Brazil, and others, right? So I think it's quite important for emerging markets that the Fed act expeditiously to put a floor under the US slowdown, engineer that softish landing in the context of a somewhat softer dollar, and help to lift the global economy once again, right? Because China is going to be doing less of the heavy lifting. India is doing maybe more than its bit, but it's probably not yet quite big enough and quite globalized enough to make enough of a difference to offset a slowdown in both the US and China, at a time when even Europe is sort of okay, but not doing that, not growing that strongly.
But what about the thesis that earlier whenever US Fed has cut the rates by 50 basis points, it has been followed by a bit of a recession. How would you rate 2024 to be different than 2007?
I think there's a host of differences between this, so-called cycle and the 2007 global financial crisis, and usual, sort of, if you want to say, garden variety recessions in recent U.S. history. Most of the time, the cycle is Fed-led, right? The easy money period sees a lot of leveraging up and a lot of development of imbalances in the private sector, which lead to overinvestment, overconsumption, and overheating eventually, and that causes the Fed to have to tighten, take away the punch bowl, as the saying goes, and then the economy slows down. And often there's some sort of a financial accident, right? Something breaks when the Fed tightens, as the old saw goes. This time, I think, famous last words in finance, but this time is quite a bit different. I mean, there have been financial eruptions, SVB and other relatively small regional banks. But there hasn't been, I don't think, the kind of leveraging up in the private sector that usually takes place in the easy money period. In fact, I would argue that we had such a long period of lowflation and so easy money because the private sector was repairing its balance sheets, right? Deleveraging, particularly the household sector and the financial sector. And the corporate sector was leveraging up, but not really for investment until very recently. Now what's happened is we've had a bit of an investment boom, but the bulk of the financing of that or the change in the leverage has come from the public sector, both through fiscal transfers during COVID, but also through the Inflation Reduction Act and the CHIPS Act and the infrastructure bill, right? So a lot of the kind of conventional things that go on in the traditional American economic cycle have not happened this time. It's been less Fed-led. It's been about a shutdown of the economy due to the lockdown and a reopening. It's been about an inflation shock driven by fiscal transfers and by supply side issues due to COVID and due to the war in Ukraine, rather than the Fed per se. And so I think, that it's quite a bit different, and I think we need to be quite careful in applying the usual historical cyclical template to this turn of the screws or loosening of the screws by the Fed. So I think there is a decent chance of a soft-ish landing, maybe not a full-blown soft landing. And I think the Fed is pushing us in that direction with this bumper cut, which is easing financial conditions, which are already easy to begin with. That should help to normalize the cycle. And eventually, I think we're going to have more conventional, Fed-led cycles.
Given the world dynamics right now with the move from the Fed, what's happening in some of the Far East economies as well, and of course India and that entire pack too, with the impending US elections, what does it all spell really for various asset classes? And I'm going to include gold in here versus equities. In the very near term, who do you think is going to outshine?
Well, look, I think, we're in a very complicated world with a great deal of uncertainty, certainly as regards the American election and as regards the implications for the rest of the world and indeed for the Fed. I think, what's on offer in the election is two very different visions, starkly different in some respects, not so different in other respects. So I think we could get quite a bit of a different set of policies under these two scenarios. And I think what the market is pricing is some, I call it quote unquote bimodal, something like 50-50 or something like that chance of either a Harris scenario or a Trump scenario. Now, I think one thing we can say with reasonably high confidence is that with Harris, we would have a more multilateralist, more globalist, more rules-based approach to the international economy, somewhat America first, as we've had under Biden, but under Trump, it would be significantly more America first, more, I would say, unilateralist, not isolationist, but unilateralist, and possibly more adversarial on trade and other issues with China and with Europe and with, other allies and partners and friends, possibly including India. Right. So a much more complicated kind of world and, behavior in the international system, which probably will have further effects of, nearshoring and maybe more onshoring, since there's a significant chance that there'll be a more aggressive renegotiation of USMCA under a President Trump than under a President Harris. Right. So the back door that China and perhaps other countries are allegedly using through Mexico to gain access or to retain access to the U.S. market, that might be further tightened, maybe significantly under Trump than under Harris. So I think it's going to be a considerably more complicated world. I think the good news for India itself is that India is probably the country that is among the most hedged, if you want to put it this way, between Trump and Harris, right? India is going to probably chart its own course, which I think is going to inevitably, sort of almost inescapably draw India closer to the West and towards the US because of challenges with China and because India is a growing economy and, obviously clearly a democracy, and also because of the diaspora in the US and the West, increasingly close ties culturally and business and finance to the West, right? China is heading in a different direction, which I would say is more about in a way, China first, right? China needs to take care of its own short-term economic challenges, as well as deal with a world that is more unfriendly, particularly a U.S. that is more unfriendly to China.
Thanks, Arnab. Great to have you on the show. Thank you so much, as always, for taking the time out.
My pleasure. Thanks for having me.
In fact, that's exactly the question that we asked Chris Wood as well from Jefferies earlier today. And here's what he has to say about the various presidential election scenarios in the US.
The single most important factor in this upcoming presidential election is that there's a decisive winner. I think that's what the market will most want to see. The worst thing for the market would be a disputed election result. So that would be my first view. For the moment, the polls remain quite close, but they are in Kamala Harris's favor. From an equity market standpoint, a Donald Trump victory would be more risk-on because he's going to be very pro-deregulation. He's going to be wanting to extend tax cuts, and he's going to be wanting to increase energy production, which could lead to a weaker oil price. So he's going to be more risk-on, whereas I think Kamala Harris would be more status quo. Probably the biggest difference between the two candidates in domestic policy would be in the energy area.
What's happening in the market, because we scaled that level of 25,800 yet again, but the bigger news is that Bank Nifty has managed to hit a fresh record high, if I have it right, Kunal, right? 800 points move and very close to that 54,000 mark. And we're talking with other technical experts as well, and they were very confident that perhaps the expiry, or the monthly expiry that is likely to happen around the 26,000 mark for the Nifty.
Yeah, I think we're just 1%, less than 1% off for the Nifty to hit that 26,000 mark. And I think what's interesting is that even after the markets being volatile on an intraday basis, I was looking at the charts, this is the 7th consecutive day where the Bank Nifty is not broken below the previous swing lows, even the previous previous day lows. So that itself tells you that even though the indices have been volatile, but it has not affected the trend for the index over the very near term. And in the last 7 days of this move, Bank Nifty has moved from 51,000 mark to almost 54,000 levels, which we are touching today. So I think this is a very strong move and a powerful move for the banking index.
I think part of that rally will also be on account of that readjustment that was going to happen, the flows that were expected for account of FTSE as well as MSCI. In fact, if we do have Soman, we should probably get him on board to discuss which are the stocks which are in focus, because perhaps in the last few minutes, the up move that we have seen could be on that account as well. Soman, which were the stocks again? Could you run us through those names?
Well, couple of rebalancing that will be happening today in the last half an hour of trade. Firstly, it's related to the FTSE September 2024 changes, and second one is the Sensex rebalancing because of the weightage changes that we'll be seeing. Now, when it comes to FTSE, around $1 billion of inflows are expected. The highest amount of inflow is expected to come in on ICICI Bank, around $236 million US dollars. Then there is Kotak Mahindra Bank, which could see an inflow of close to $105 million US dollars. Apart from that, in fresh additions, it's GE, T&D, Endurance Tech, KEI Industries, Hitachi Energy, Lloyds Metal, which could see an inflow of anywhere between 17 to 53 million US dollars. Then there is IRB Infra, Escorts, Kubota, Motilal Oswal, Central Bank of India, Bank of Maharashtra, Bharat Dynamics, Hudco, Cochin Shipyard, which could see inflows of anywhere between 7 to 37 million US dollars. Mahindra and Mahindra could see some outflow of close to 65 million US dollars on the back of lower weightage in the FTSE index. However, that could be offset by around similar amount of inflows that is expected when it comes to the Sensex rebalancing. Now, in Sensex rebalancing, Mahindra and Mahindra's weight is increasing, and that's the reason we are expecting a similar amount of inflow on that front. Apart from that, it's Bajaj Finserv and Axis Bank, which could see an inflow of close to 7 to 30 million US dollars. Then there are multiple stocks which are seeing lower weightages in the Sensex, and that is Reliance Industries, Ultratech, Infosys, HDFC Bank, ICICI Bank, TCS and L&T. And on the back of lower weightages, the outflows expected in these stocks are anywhere between 5 to 12 million US dollars.
Right, we leave it at that, Somit. Let's get in some BTST trades as well, shall we? On that note, Naresh, what's on your list?
So first is the buy on Havells, good momentum here, stop loss at 2010, target price of 2080. Second is the buy on Eicher Motors, which came close to a new all-time high, stop loss at 4960, target price of 5100.
Kunal, what's on your list?
So I'll go to buy an ICICI Pru. That's a chart which is looking attractive towards a breakout. Buy with a target of 790, stop loss at 756. And L&T is a stock which is also confirming a breakout. So, that's a buy, targets of 3820. In fact, could be revised higher to now 3840. Stop loss could now be trailed to 3750 mark.
Okay, so those are some of the BDSE trades which have been recommended. But Naresh, what's happening with M&M? And is this move likely to continue? Almost 3,000 or 2950 on the stock right now.
So good enough 4 months of consolidation and did not see much of a correction. So has been showing a lot of strength. Finally, a breakout done into very close to making new all-time high. So bias is positive. We are seeing a revival in auto again. So you have Eicher Motors doing a knock to new all-time highs. You have even Maruti making a take up, Escorts Kubota. So looks like a fresh trend for Mahindra and Mahindra.
Yeah, it's going to coincide, I guess, with all the festive sales that we may see. In fact, that's one key trigger that the market is waiting for as well. How this festival season is going to pan out for some of these consumption sectors and whether there's going to be any revival in sales or not. But yeah, it's an important weekend as well. India and Japan will both be participating in the Quad Leaders Summit in Biden's home state of Delaware. So a lot of interactions as well, I guess, is what we're going to hear over the weekend. From Prime Minister Narendra Modi's visit to the US, which of course we're going to be tracking very, very closely. In the meantime, let's just see what are the big trends which are building up. We just flagged off what some of the auto names are up to, but this week has been quite the historic one. Finally got done with the Fed move, and it was definitely a surprise, a 50 bips cut. But net result, the world markets, at least our markets on a net basis, have managed to do quite okay, finishing it off at a record high and closing in with a decent gain for this week. But I'll hand it over to Ashesha for the closing trades.
Well, absolutely. It turned out to be a great day for the Indian markets today. Nifty closing above that 24,800 odd mark. On the Nifty Bank as well, we remember this is the 7th consecutive day where Nifty Bank is ending in the green. A jump up of nearly 600 points, nearly 850 points on the Nifty Bank. 53,916 is where the Nifty Bank is currently at. Top gainers include the likes of ICICI Bank, HDFC Bank and Kotak Mahindra Bank. ICICI Bank perched up in trade with gains of nearly 4.5%. Nifty Realty Index, this was also shining in trade today, up nearly 2.5%. The biggest sectoral gainer by the end of today's trading session, Nifty Realty up 4%, and we have Lodha, or rather Macrotech Developers, Sobha and DLF, some of the top gainers on the Nifty Realty Index. Apart from this, we also saw a lot of action in auto stocks. Nifty Auto Index was also gaining nearly 2%. We had M&M, which was the top gainer on the Nifty 50 Index. Nifty Auto Index up 2%. M&M ending the day with gains of nearly 5.5%. We had Bosch and Maruti, some of the other top gainers on the Nifty Auto Index. On the losing side though, PSU banking stocks have been on a breather for quite some time now. Today also, this was the only sectoral index to end in the red. In fact, we have seen some bit of recovery in Nifty PSU Banking Index. SBI, Bank of Maharashtra, Central Bank, Indian Bank, all of these stocks ending the day with some cuts. Apart from this, all of these exchanges stocks have been in focus for quite some time. We had BSE, which was up nearly 8% today on the back of NSE listing. This stock gaining 6.5%. Shipping stocks were also in focus today. We had an ET Now exclusive with respect to some developments that could take place. Garden Reach Shipbuilders up 9%. Cochin Shipyard was also gaining nearly 10% in today's trading session. Moscow Dock up 7.5%. Apart from that, a couple of newsmakers in trade today. We had metals which were shining bright. Remember some positive news flow that came in from China with respect to home purchases and the restrictions being listed. We had Nifty Metal Index up nearly 1.5%. JSW Steel up 4%. ITD Cementation, it was locked in upper circuit of 20% on the back of Economic Times report. ITD Cementation locked in upper circuit of 20%. So yes, a whole host of stocks in focus today, but Nifty and Nifty Bank were shining bright in trade today. Nifty ending about that 25,820 odd mark.